Hey, what's going on everyone? It's Griffin here, and with the state of seemingly every single market absolutely collapsing right now, well, I wanted to make a quick video sharing my thoughts on how I'm navigating these waters, because seriously, a lot of investors, especially investors who may have started in early 2020, are now in a position where they're losing quite a bit of money, even if only paper losses for now, but this is a serious issue that definitely needs to be addressed. The reality is that the past 2.5 years have pretty much been like a dream for new investors, where blindly picking any set of stocks or any property that even has just a working toilet in it has resulted in serious financial gain, which we need to understand is definitely out of the ordinary. And look, I can't say this hasn't been highly beneficial to many, but the problem is that this has sort of created a false precedent for what being an investor is, especially when you're staying the course and navigating through different market cycles, well, like right now. Weight of the financial markets is definitely heavy on most of our portfolios, with articles being released daily spreading even more uncertainty about a recession, equities continuing to fall to pre-pandemic lows, as well as an impeding real estate crash that might be on the horizon. When everyone's making money, people want to think of themselves as a long-term investor, right? But as soon as things start veering off course, well, all of a sudden, any sense of a financial plan whatsoever is completely thrown out the window. And being an investor myself, but then also a creator in the finance space for now more than 3 years, well, I'm seeing firsthand the massive drop-off in interest towards investing from the retail community, as well as the lack of really just understanding and commitment towards what it truly means to stay invested and be a long-term investor. So obviously one single YouTube video probably won't be a large enough catalyst, but that's exactly what I hope to change in your investor mindset if you're watching this right now. I'm here for the long term and you really should be as well, so let's get into it. After 2 years of quantitative easing from the American Federal Reserve as well as other governments around the world, printing money like there's pretty much no tomorrow in order to support the economy while business closures ravage the nation, well, of course this ballooned into the market peak experienced at the tail end of 2021 in the equity markets. And while this did definitely save us from what may have very well been a more devastating financial outcome at the time, well, now we're left with the repercussions of this loose monetary policy, notably the highest inflation experienced since 1980 and consumer sentiment at all-time lows. That being said, unlike in 2008, where the collapse of the financial markets themselves are what ended up hurling us into a recession, well, the current circumstances are quite different, especially across different asset classes. Well, notably real estate versus everything else. So I don't want to say that this time is different, but actually it kind of is, and that even though large trends and patterns tend to repeat themselves historically, well, every particular event is stemmed from a unique set of circumstances. Entire asset markets, along with specific assets within each one of these markets, have different levels of liquidity, essentially meaning how fast can I offload these assets over to my neighbor when things start going south, and current market movements are reacting in accordance with these levels of liquidity. Right now, crypto and stocks, which have the highest liquidity levels, are selling off like crazy, pretty much shutting off any gains experienced since the 2020 flash crash, with those liquidities ironically being converted back to cash and also flowing towards safe haven assets. Yeah, sell all of your bleeding positions and invest them into positions that are increasing in value. Buy high, sell low. I'm pretty sure that's the saying. Okay, obviously I'm joking, sort of, because the reality is that there are very few options in the market right now, which is leading to a lot of investors preferring to even hold cash even though they are losing out on massive buying power due to the higher levels of inflation, right? And that is, instead of staying invested, staying the course, and taking advantage of this massive buying opportunity when it comes to broad market funds and other asset classes that are significantly depleted in market value, but that held over a long enough period of time are going to actually represent the best buying opportunities to create higher returns on investment over the long term. On the flip side, real estate is highly illiquid, where offloading your house in a market where inventory is still extremely tight and prices are high has kept this market from significantly crashing like stocks and crypto, at least for the time being. So what should we do then? Well, let's get a bit more context about what's actually going on, because this may or may not give you a bit more reassurance. Breaking news, the American stock market is now in a bear market, but you already knew that because you're subscribed to this channel. Now, historically speaking, there have actually been 29 bear markets since 1929, with average declines of right around 35% per bear market. So this would mean that based on these historic averages, we could see the S&P 500 actually probably drop down to a value of right around 3,100. Or as John Stolfus is predicting, it'll close off the year at 5,300. Hey, I like the optimism. Regardless, no one really knows where we're headed, as again, this unique mix of macroeconomic as well as international circumstances is unique to right now in 2022, with each element working for and against themselves. Current inflation levels are much higher than in the past two recessions, real recessions that is in 2000 and 2008, unemployment still remains extremely low compared to what they were during the, again, 2000 and 2008 recessions. Interest rates are climbing at an extremely rapid pace. Supply shortages and labor shortages are also an issue right now that is also leading to, increased actual price of goods. There's international unrest. The list can really go on here. So with this in mind, repeatedly and accurately predicting economic events and really just what's to come in the financial markets is what could be considered to be bordering on delusion or just hoping to strike it big on the next Powerball. From the moment that I personally got interested in investing years ago, whether or not it's stocks, crypto, real estate, whatever asset class it might be, this has always been met with some reluctance from those around me, specifically in certain environments though, like at work, where investing isn't necessarily a top priority. Of course, this isn't my environment anymore, but the point being that middle and lower middle class individuals tend to actually view any type of investing at all as risky, which is interesting because based on my own research, the main differentiating factor between the middle class and the wealthy is their capacity to invest and deploy a large amount of capital into the equity markets as well as real estate during recessionary periods when asset prices are down 20, 30, 40%. This, once again, is the main way that individuals are able to create long-term wealth in the markets. But the thing is, people will always have a reason not to invest or view any type of market condition as not ideal. Back when I started buying real estate, I remember specifically coworkers telling me that this was a risky business and that they wouldn't want to deal with tenants cleaning toilets. But from my own experience, this has been one of the best financial decisions that I've ever made. And if we do see the market go down 20, 30%, which for the record, I don't necessarily think we will, but if that does end up happening, well, great, because this will be a further opportunity to deploy more capital into this portfolio for long-term growth. When it comes to real estate specifically, I'm in no way interested in speculating on the assets. I'm looking at cash flows as well as accurately predicting the return on investment that I'm going to be able to create over a given period of time. Since then, of course, the markets have appreciated significantly, and I won't deny that there definitely has been some luck associated with when I got into the markets, but I am not looking to actually time the markets. I just happened to be 20 years old at the time and started getting interested in real estate investing at that given moment. But had it been any other period, the exact same thing would have happened, where I would have started getting interested in it, taking action, and actually investing in my future. And really, the exact same thing holds true with stock market investing. Although sure, I've had a fun time in 2020 and 2021 speculating on some small cap positions or meme stocks, as millions of individual real estate investors did as well. Well, never did I let all of these positions combined make up more than only a couple percentage of my entire portfolio. I've been stock investing since 2017, and over this period of time, I have learned the importance of having a well-diversified portfolio that actually meets your investor profile in accordance with your risk tolerance. By the way, if you're currently in a position where you want to learn more about how to actually navigate the markets properly and build a portfolio suitable for your needs as an investor based on your risk tolerance, your age, your time horizon, and all of that information that's relevant to you, make sure to check out the link down below in my description to my stock market investing course. That's over on Skillshare. You can access the entire thing completely for free on a 1-month free trial. Okay, now the excitement of the retail community towards investing over the past couple of years, I actually think is fantastic, right? As someone who's pretty much based their entire career off of sharing financial news as well as any type of guidance that I'm able to share from my own experience, well, obviously this makes me really happy to see a large population of individuals that are now interested in personal finance, investing into their own financial future, and really just bettering their financial position. But there's a difference between long-term investing in quality and broad market ETFs or blue chip dividend stocks versus simply holding on to, say, a meme stock because you're anchoring your position to a previous high that asset may have reached when valuations were run up dramatically due to all of the quantitative easing and euphoria in the stock market. So while Robinhood and other platforms made it fun to invest, even gamifying the concept, well, investing isn't necessarily something that's fun or overly stimulating. Rather, it's consistently buying into quality assets and really just being super patient. If you're in a position right now where you have multiple stocks in your portfolio that might be down multiple double-digit percentages and that you only got into those positions in the first place based on hype and speculation, but that you've now lost conviction in and you're not actually keeping up with the underlying financial and business growth of the company in question because you're investing for the long term, then taking those losses on the chin and just reinvesting that money into actual positions like broad market ETFs, quality dividend stocks that are going to fit into your new asset allocation mix for long-term growth is most likely the best course of action. I've said it before and I'll say it again, the most successful investors recommend consistently buying low-cost ETFs rather than actively trying to beat the market. And this is especially true for everyday people that aren't spending their every waking minute reading through financial statements and trying to beat the market by 5%. Now, will things get worse? That, of course, is the burning question. And as we looked over earlier, well, based on historic averages where bear markets tend to have the market depreciate by around 35%, this does leave some further room for the S&P 500 to continue dropping down. That's not to say that this will end up happening. However, based on historic averages, this could very well materialize. That being said, this is why I always advocate for an emergency fund, 3 to 6 months worth of your expenses, and really having proper financial habits in all market environments, whether or not we're in a bear market or a bull market. This is something that if you've been following my channel for the past multiple years, I have never wavered from this advice, because this is truly the way that you're able to gain control over your finances and feel comfortable deploying capital into the markets regardless of the market environment. So thanks a lot for watching today's video. I really hope you enjoyed it. If you did, make sure to drop a like. It really helps the channel out. And of course, subscribe, hit the bell button if you want to be notified of new and upcoming stock, real estate, and personal finance videos. With that said, of course, check out the links in the description for free courses as well as free money when you open up certain brokerage accounts. With that said, thanks for watching, and I'll see you in the next one.